Welcome back, guys. Now let's look at this question. It says that SPLC is a company with a 31st December year end. 1st January in year 1, XPLC grants 100 options to each of its 500 employees. Each grant, is conditional upon the employee working for XPLC over the next 3 years. At the grant date, XPLC estimates the fair value of each option to be 15 currency units, and 20% of employees will leave over the vesting period. So you're required to calculate the income statement of profit or loss for each year of the vesting period if everything turns out exactly as expected. Now, just like the previous question, on 31st December year 1, you know that the vesting period is 3 years, so we need to recognize the expense over the 3 years. So at the end of year 1, we will need to calculate the value of the share option that we expect would vest. And the question told us that all through the 3 years, that's the only estimate, that 20% of employees will leave. That means 80% will exercise their share option. So the value of the share option at the end of year 1 will be 80% multiplied by the total number of employees, which is 500 employees, multiplied by the total number of options, which is 100 options, multiplied by the price or the fair value of the share option, which is 15. So we get 600,000. So the remuneration expense relating to year 1 will be 600,000 divided by 3, and that gives 200,000. So that is the remuneration expense that will be recognized in the statement of profit or loss in year 1. At the end of year 2, we re-estimate the number of share options that we vest. The estimate remains the same, so 20% is expected to leave, so 80%. Multiplied by 500 employees, multiplied by the number of options, multiplied by the price per option, gives 600,000 also. So cumulatively, up to the 2nd year, the total expense will be 600,000, this 600,000 multiplied by 2 years all upon 3 years, that gives 400,000. It will be wrong to do 600 over 3 in the 2nd year. It is very wrong. So you need to determine the cumulative remuneration expense first. Then we'll now look at the increase or decrease. In this case, it's an increase in expense because in year 1, the expense is 200. Cumulatively, up to year 2 is now 400. So for year 2, that relating to year 2 will be 400 minus 200,000. And that gives 200,000 for the remuneration expense that will be recognized in the statement of profit or loss in year 2. However, in year 3, value of the option still remains 80% times 500,000 times 100 multiplied by 15, which is 600,000. Therefore, the remuneration expense for year 3 is 600,000 minus the cumulative in year 2, which is 400. So that gives us 200,000 for year 3. And that is it. See you in the next video. Cheers.